In this video, I'm going to cover the different types of tax entities that you can use for operating your business. I'll explain to you the differences of each of the entities, and I'll help you understand how to pick the right entity for your business. If you haven't done so already, you should start by watching my video that I'll link to below on the different types of legal entities. That is a separate concept from this. So in that video, I covered the different types of legal entities that you could set up for your business, like LLCs, for example. And in this video, we're going to cover what the tax treatment of that entity should be. So there's 4 different types of tax entities that we're going to cover, from single member LLCs to S corporations, which I'm sure a lot of you have heard of, and partnerships and C corporations. So before we start, I want you to understand how basic this is and how easy it can be to get this wrong and correct a mistake if this wasn't done right in the past. So let's say you have business that's making $50,000 a year. If that's the net profits of your business, if you don't have the right entity set up, for example, if you're using a partnership when you should be using an S corp, you could be potentially paying up to $4,000 more in taxes on that money that you didn't need to pay. So again, that's a very easy fix. We could easily just switch and have used the right tax entity for our business and saved ourselves $4,000 a year. And that's only $4,000 of tax savings on 50 grand. So once your business is making a lot more, the tax savings on that is going to multiply and be a lot higher. So it is very important that you pick the right tax entity, that you understand why you use that tax entity, and that you also operate it properly. So if you don't set up the right tax entity, you are paying or could be paying a ton more in taxes than you should be. I see a lot of people make the mistake about, oh, it's not that big of a deal from a tax standpoint, it's only a little bit more money. That is not true. I've seen people use C corporations when they shouldn't have, and they paid millions more in tax than they needed to. So the right tax entity is a very easy situation to figure out, but it can also save you a lot in taxes. So let's go ahead and dive right into the different types of tax entities. So to start with, we have the single member LLC. So this is a situation where you have a single owner of a business. So the business only has one owner that owns 100%, and they have an LLC, for example, and they don't make any tax elections. So they're not making an S corp election and they're not making a C corp election, for example. So they have what we call single member LLCs. These entities have a single layer of tax. So you don't pay a corporate tax on any type of, profits of the business. It just flows through directly to the owner. So the first 3 types of tax entities we're going to cover are all flow-through entities. When I say flow-through, I mean you don't pay an entity level tax and the income just flows through to you on a current basis. That means we have no deferral. So you're picking up that income whether or not you distribute it out of your LLC from your company to yourself. You have to pay tax on that money. The type of the income, whether it's ordinary income or capital gains, if you sold, assets and generate capital gains, that is going to also flow through. So whatever the income category would have been at the level of the entity, that is the same category that's going to apply to you. So the type of income flows through to you as well. The income that the business earns, the net profits, are going to be subject to and eligible for the 20% QBI deduction. So that's a great tax deduction that I've talked a lot about in other videos. You are going to be eligible for that deduction on the profits of the business. And this is a reason why we commonly don't use these types of entities, you're going to pay payroll tax on 100% of your profits. So this is why in a lot of cases we use the structure that I'm going to talk about next, which is the S corporation, because we can avoid some of that payroll tax. And you might think payroll taxes aren't that big of a deal, but they are huge. And they really add up. Obviously the more and more money you make, the more payroll tax you're paying. And in a lot of cases, what's really scary is you don't know you're paying these. So they might show up in a way or paid out through your payroll provider in a way that you don't even know you're paying payroll tax. So payroll tax are huge, and they also can be kind of pesky in the sense that you might not even see or have full visibility into what you're paying. So you want to plan around those if you can. And again, a single member LLC, there's no tax election made. So you might think there's never a situation where you would want this type of structure, but that is not the case, because you either might have a situation where an S corporation is not beneficial in some cases, which I'll talk to you about when we talk about S corporations, or you may not be making enough money to justify making that S corp election. So single member LLCs are not that common in practice, but there can be situations where you use these entities, and that is going to be a situation where the S corporation structure is not right for you. So I'll talk more about that in the next slide, but you typically don't want S corps in New York City, for example, because they don't respect the S corp structure. Or DC also can have some bad impacts if you make an S corp election. So lots of times, and I myself have businesses that I operate in New York City that are single member LLCs because the S corp election would be detrimental to me. Also, there's some limitations on who can make tax elections. So if you've got foreign owners or something like that, you may find yourself having to use the single member LLC structure. So again, this is not the preferred structure unless you're in a jurisdiction where you cannot, or just otherwise have a fact pattern where you cannot make an S corp election. So that brings us to the S corporation. So this is the most common structure for operating your business. If you're a small to mid-sized business, you are almost always going to be an S corporation. It's the same as the single member LLC where it's single layer of tax. We don't pay an entity tax. We do sometimes have franchise taxes, but those are usually a couple $100, not a big deal. And we can pay, again, we don't have any deferral. We pay tax on a current basis. Type of income is maintained. You do have to pay yourself a salary. So this is one difference between the S corporation and single member LLC is that when you set up the S corp and you make the election to be an S corporation, you as the owner are usually going to have to receive a salary. So you're going to have to designate some piece of the profits of the S corp that would be a salary to the owner, and that's based on your activities and what you do for the business. I have separate videos on that, how to decide what the right salary is. But you are typically going to have to pay yourself a salary. You still get the 20% qualified business income deduction on your non-salary profits. So that doesn't apply to what you pay yourself as a salary, but you do still get that deduction on the net profits of the S corp after taking into account your salary. You do not pay payroll tax on the profits of the business. You only pay payroll tax on the salary that you have to pay yourself. So typically you want to do planning to lower that salary as low as possible. And I talk a lot about that in my other videos, but you are only going to have to pay payroll tax on the salary. So this is why this is the most preferred structure over the single member LLC. If you can, do it and not have a situation like New York City or DC where you shouldn't make this election, you can avoid a lot of payroll taxes. So the S corp is really a payroll tax reduction strategy. And if you aren't familiar with that strategy, I'll link below to my S corp payroll reduction strategy so that you can understand how the strategy works, how to put it in place, and also when you shouldn't make an S corp election, like if you're in New York City, for example. To be an S corp, you actually have to file an election with the IRS. To do that, I've talked in other videos about how to do that, file that election, but you do actually have to affirmatively elect to be an S corporation. As I mentioned, there's some limitations. You can't usually have foreign owners of an S corporation. So if you've got, a co-owner of a business that's a foreign individual that doesn't reside in the U.S., they typically are not going to be able to be an owner of an S corp. So you might need a different structure in that case. You can't have more than 100 shareholders. So there are some limitations in S corps. Also, as I've mentioned repeatedly, there's some jurisdictions that don't respect S corporations like Washington, D.C., and New York City that make it where you actually might be paying more tax once you make the S corp election. So S corp is not always the preferred structure. I see this get misconstrued a lot in practice, but do not just assume you should make an S corp election. Check out my video on the payroll tax reduction strategy also so you understand how the strategy works with S corps. The next entity is a partnership. So this is very similar to the others in the sense that it's a single layer of tax. No deferral, type of income is maintained. You also have to pay a salary to the owners. So partnerships have to have two owners. So if we just set up a business, let's say we set up an LLC and it's me and a co-owner of my business and we own it 50-50. That is going to default into a partnership if we don't make an election to be an S corp or a C corp. So a partnership is a little bit different in the sense of just the terminology. You still have to pay a salary to the owners based on their activities, but we call those guaranteed payments. So it's just a terminology difference. You still get QBI deduction on non-salary profits. So anything that's the net profits of the partnership, you get the QBI deduction. The problem is that if you have active partners, you can have a situation where they're paying payroll tax on 100% of their profit. So it kind of kicks you back to the single member LLC structure where it's a bad result from a payroll tax standpoint. You can have certain cases where limited partners might not have to pay payroll tax, but that is a bit of a gray area in the law, and I think it's very risky to have that structure. So typically you're going to have a bad payroll tax situation, especially for, someone who's actively involved in the business. Also, partnerships introduce more complexity, and they're just difficult from a tax standpoint. A lot of CPAs just don't even want to touch a partnership return because they're just a big pain. I can tell you from having done a lot of partnership tax planning in the past for investment funds and stuff, but they're typically more complex from a tax standpoint. You don't need an election to be a partnership because it's just the default if you've got multiple owners. But again, unless you're in a situation where you can't use an S Corp, as I mentioned before, this is typically not going to be the preferred structure. You typically always want an S Corp unless you're in a situation or fact pattern where S Corp is not beneficial. So that's a partnership. Again, you don't see these a lot. When I do see these, it's usually, because it wasn't set up properly. So the last type of entity I'm going to talk about is a C corporation. So this is very different from the first three. So this is actually a non-flow-through structure. So you do have a double layer of tax. So the corporation itself pays tax, and then you pay tax on distributions, what we call dividends from the corporation. So the corporation pays tax on the profits, and then if I want to distribute those profits out to me, I pay tax again on that. So this is why C corporations are almost always bad, and we typically do not want to use these structures unless we absolutely have to, like we're a big company or we want to go public in the future, for example. As I mentioned, double layer of tax, pay corporate tax and personal tax on distributions. Distributions are what we call dividends from the company. They may be subject to that lower, capital gains tax rate because they're qualified dividends in most cases, but you're still paying double layer of tax and it's still not great. You still have to pay a salary to the owner. So as the owner of the company, you're still getting a salary out of the C Corp. Same as with the S Corp and partnership. So those same kind of principles apply there. You don't get any 20% Q-by deduction. So this is another reason why this is a really bad structure in most cases, that you're paying double layer of tax and you don't get that great deduction, which is the 20% qualified business income deduction. Some people like to set up C Corps thinking that they're going to get the qualified small business stock exclusion. It's called the 1202 exclusion. I have a lot of videos on that. You can do that and exempt the gain. You can exempt 10 million, in some cases higher. I have videos where, I talk about the planning of how to get exempt gain above 10 million using that. But that is only if it's a stock sale. So I've said this repeatedly. If you're operating a small to mid-sized business, it's unlikely you're going to be able to accomplish a stock sale. When you do sell the company, the buyer's almost always going to insist that it be an asset sale, especially if it's a buyer that has any clue what they're doing. So in order for you to get that qualified small business stock exclusion, you have to do a stock sale when you exit your company. So again, keep that in mind. I know a lot of people like to try the C Corp structure in order to go for that, but in a lot of cases, that is not going to be something that's possible or practical. So if you are thinking about doing that, I highly encourage you to check out my other videos on that and the warnings that I have around that. You only pay payroll tax on the salary, so it is a little bit better from a payroll tax standpoint. But you, again, you've got the double layer of tax. You don't get the Q-by deduction. So the payroll tax savings are really going to be minimal at that point. So you don't want this structure unless you have to have this structure. So you don't want this structure unless you're a very large company or you're wanting to IPO at some point, or you're just positive that you can get this 1202 qualified small business stock exclusion. And the exclusion of, not having to pay tax on the gain is more of a savings than the extra tax you're going to have to pay in operating a C Corp structure. You need to make a C Corp election if you have an LLC, for example. Like if you're the single member owner of an LLC and you want to be a C Corp, you're going to have to file an election to do that, similar with the S Corp. If you set up as a corporation or incorporated, you're going to default to a C Corp in most cases, so you don't need to file something there. I always file protective elections no matter what. But keep in mind that if you're wanting a C Corp structure, you may or may not need to file a tax election. So this is just a good summary of the different types of entities. So I want to make sure it just kind of brings everything together that you can see this. So the 20% qualified business income deduction is huge. This is a huge deduction on your net business profits. You get this with every structure except for the C Corp. So you can see why C Corps are bad there. You get the payroll tax reduction with an S Corp and a C Corp. You only have a single layer of a tax. With the flow-through structures, you're not going to have that with the C Corp because we know there's a double layer of tax. Type of income is maintained, which is a positive thing, because if for some reason if our business sells assets and it's capital gains, we want to be able to get that lower capital gains rate on that. So that's a positive to have the type of income maintained. You need elections with S Corps and C Corps. So remember, you may have to file an election for a C Corp in some cases. And if it's an S Corp, you're going to have to affirmatively elect that. There are additional tax returns. So I did want to make sure that's clear. Once you file elections, if for an S Corp or a C Corp, there are different tax returns. If it's a single member LLC, it's just going to be reported on the Schedule C with your 1040, so no additional business return there. If it's an S Corp, you're going to have an 1120S for the S Corp. Even though that entity doesn't pay tax, it still has to file that form. Same with the partnership. They have what's called a 1065 is their form. No tax is paid on that at the federal level, but you still have to file that form with the IRS. And a C Corp files an 1120. They do pay tax on that form if they have net profits. And you've got to file that separate business entity form with the IRS. So again, this is a good overview of the different types of tax entities. I highly encourage you to check this out before you set up your business, or if you're already operating, to make sure you have the right structure. Don't just assume you should have the S Corp in every case. There can be situations where it's not good. If you have a partnership or single member LLC, think about, was that the right structure? If you made a C Corp election, you're thinking maybe that wasn't a good idea. You might want to unwind that and get out of that, but it's critical that you understand the right structure for operating your business from a tax standpoint, because that can have a huge impact on the amount of taxes you pay. So hopefully you found this video helpful. If you did, please like the video and subscribe to our channel.